Hi, Scott from Luminary Wealth here. Welcome to Illuminate, where we explore the science of investing based in evidence, not in speculation. Today we're going to review an article written by Dimensional Fund Advisors titled Under the Macroscope: When Stocks and the Economy Diverge. Are you just a little perplexed at the market's positive trend, especially as bad as the economic news has been? Last week, jobless claims reached nearly 39 million, bringing unemployment to almost 15%. Yet as of this recording on 5/26, the Dow Jones was up almost 530 points, bringing us back to even a little better than it was exactly 1 year ago on 5/26 of 19. Well, if you are a little confused, you're not alone. So what's going on here? Well, let me review with you one possible answer Dimensional has shared in this article. The general idea is that markets are forward-looking. That is, investors pricing stocks today use all information available to them to estimate how the future economic conditions will impact the cash flows of the companies they are valuing. For example, if the consensus of all analysts is that the economic conditions will weaken a company's cash flows, we may see the value of that stock decline well in advance of when the cash flows actually decline. You see, the economic news we're reading today was already estimated into yesterday's prices, and the stock market will move up or down depending on how the actual economic results compare with the estimates that were used in yesterday's valuation. So if the results are better than expected, poor economic news can result in positive stock price movement. We can see this forward-looking behavior of markets by looking at the relationship between the United States gross domestic product and the equity premium. You see, the equity premium is simply a fancy way economists describe the return advantage you get by investing in stocks over a risk-free asset like 1-month Treasury bills. Now take a look at this slide with me. So we're looking at a scatter plot chart here, and what we're comparing is the GDP in the current year across the horizontal axis here, and then on the vertical axis we're seeing what was the equity premium, again that stock return over a risk-free rate. It's the reward you get from taking more risk. And so you would imagine that as GDP went up, the equity premium would go up, and as it went down, you would expect a lower equity premium. But you can see from this scatter chart here, when we compare equity premium and GDP in the same year, we really don't see a definitive relationship. We actually have kind of quite a few in that bunch. You've got even those on the high positive equity premiums when you have a negative GDP in the same year. So remember, the article does emphasize that this plot chart result is not implying that financial markets ignore macroeconomic data like GDP. It's just that GDP captures metrics beyond corporate profits, and so it makes it an imprecise measure of the economic activities that drive stock market prices. However, we're going to take a look at the next plot chart and show that there are other factors that can explain why we don't see the relationship between these two variables as we would expect. So moving to chart 2, it looks a lot like the first chart, except we're comparing now equity premiums the year before GDP growth. So again, GDP on the horizontal axis, equity premiums on the vertical axis. Now you can see, if we draw this, kind of capture most except the outliers, now you see this upward to the right slope, meaning that we see a greater correlation between equity premiums the year before GDP actually is reported. The positive direction suggests that equity prices moved in advance of actual GDP changes occurring the following year. Now, this is what we would expect to see if markets priced in future economic expectations. Now, let's turn to headlines worrying some investors. The government's massive stimulus and liquidity spending designed to ease the economic impact of the COVID-19 pandemic. How will the increasing debt load borne by the U.S. government affect future stock returns? Taking a look at Exhibit 2 in the article should signal some hope to worried investors. Debt to GDP is a ratio used to estimate a country's ability to repay its debt. And the chart compares equity premiums for high debt countries to those from low debt countries. The comparison was done for both developed and emerging markets. So the top panel we'll be looking at is taking prior year's debt to GDP ratio, comparing that to what the equity premium is in the current year. And the panel sorted countries from high debt countries to low debt countries. And if we can see here, both for developed and emerging, there is not a significant difference between the equity premiums between high debt and low debt countries. Well, that's using last year's GDP. What about the current year, where we expect that debt to GDP to be significantly higher at the end of the year than where it was at the beginning? So this next bottom panel took the same year debt to GDP, projecting the debt to GDP at the end of the year, and compared that to the current year's equity premium. And what did we find here? Again, no significant difference between high debt countries and low debt countries. So the final takeaway is that just like the results above for GDP growth, these results also imply that markets priced in expectations of future government debt. I hope these examples show you that stock markets indeed value stocks today based on tomorrow's expected economic outcomes and not on yesterday's results. Until next time, stay safe and stay healthy.